Let's officially kick it off. So welcome everybody. Today we're going to do a training about funding and GASB 6768 as well as GASB 7475 actuarial reporting. Today's training is going to be for applied use in regards to Illinois municipal governments as well as Illinois pension fund reporting from an actuarial standpoint. So today some of the things we'll go over. We'll talk about our learning objective today. We'll go through funding reports, GASB 6768 reports, GASB 7475 reports. For some of you, these terms might be new. We'll kind of break that down a little bit. We'll talk about some of the differences between these two reports, and also just why are these reports important, why they matter. So today's objective, as we talk through the different elements that we're going to cover, is to understand the differences and some of the similarities between funding and GASB reports, with the intention to be able to make the most informed decisions for your entity, whether that be municipality, school district, park district, pension fund, whatever that is. Starting off, what is an actuarial funding report? We produce well over 350 of these actuarial reports per year in our department at Lauterbach and Naaman. And these reports we're going to speak to them in the context of Illinois government. So in the context of that, these reports for Illinois governments are based on Illinois pension code. So there's a lot of different components that go into an actuarial valuation that end up in an actuarial report. I like to think of what we do is, if you think about what accounting is, when you're doing accounting, you're looking at events that have transpired and you're recording these transactions for your financial statements. When you're doing actuarial reporting, you're looking at events that have not yet transpired. So we're trying to predict the future. When predicting the future, obviously it comes with a lot of uncertainty. There's a lot of assumptions. We'll get into that. But there's really four key components when it comes to an actuarial report. There's data, assumptions, methods, and plan provisions. The part that comes from Illinois pension code is plan provisions. The rest, maybe with the exception of funding policy, which is kind of methods, is basically determined on a case-by-case basis for each pension fund or municipality that we're working with. The key disclosure in our reports in an actuarial funding report is the recommended contributions determined on an annual basis and the alternative contribution. We'll get into what that means in a bit. And that's to the pension fund from the municipality. And also we'll talk a little bit about, we do also actuarial funding reports for OPEB trusts, which is kind of a whole different thing. It's unrelated to pension funds. OPEB stands for other post-employment benefits. So I like to think of it as, if you think pension, that's one post-employment benefit that employees are entitled to. OPEB is basically all the other post-employment benefits that employees may be entitled to. Think life insurance, dental, vision, and most importantly, medical insurance. In these reports, there's a lot of key metrics that are going to inform us as to the overall health and status of the pension fund. So it's really important to review these reports on an annual basis. Switching gears a little bit, what's a GASB 6768 report? GASB, if you don't know, stands for Governmental Accounting Standards Board. Prior to GASB 6768, there was GASB 25. That was up through 2015. That was the old standard by which pension funds were recorded in municipal financial statements. But now under GASB 6768, basically when we do this report, it's an evaluation of where we're at today. So current assets, current members in the fund, and then expected future everything, future contributions, that's employee and employer, expected future benefit payments, and expenses. The idea with the GASB 6768 report that's kind of critical to this, and we'll break this down a little bit in a minute, is we're trying to determine if there's enough cash flow in the pension fund to cover all future benefit payments for the current membership. And we'll talk about that. Some of the key disclosures that you'll find in a GASB 6768 report that ultimately transfer into the municipality's audit on an annual basis, aka the annual financial report or the annual comprehensive financial report, is the net pension liability, or if it was, net pension liability, pension expense, and then the 10-year histories can be a really useful disclosure in there that ends up in the required supplementary information in the audit. It shows you a 10-year history of how much has been contributed to a pension fund compared to what was recommended. and also a 10-year history of the net pension liability. So you can see kind of over time the trends within that fund. And then we also include some other, there's tons of other disclosures in there. Those are the most notable. The last piece would be expected rates of return by asset class. Prior to pension consolidation that happened a few years ago, this was a really key piece of information because it was determined from local investment advisors how they projected different asset classes to perform over time. Now, in a post-consolidation world, it's the same for every fund because every fund is invested the same way with either IFPIF, the Illinois Firefighters Pension Investment Fund, or IPOPIF, the Illinois Police Officers Pension Investment Fund. Shifting gears again into GASB 7475 report. So this is, so everything I talked about so far, funding report and GASB 6768 report is generally going to be geared towards pension funds. GASB 7475, totally different. So for anyone who works with pension funds, GASB 7475 reports are irrelevant to pension funding, has nothing to do with that. It is still part of a municipality's audit, and this is what covers those OPEB benefits. So anything not pension, that's a retirement benefit that employees are entitled to, is reported and disclosed in financial statements under GASB 7475. So you can see the key items there that I already targeted. Similar exhibits, so GASB 6768 and GASB 7475 reports look very similar. By the way, and I forgot to mention, when I say 6768, 67 basically covers the pension fund, 68 covers the municipality. So we just combine them in one. Other actuaries issue them as two separate reports. It's pretty rare, but I've seen it a couple times. GASB 7475, kind of the same deal. It's about the OPEB fund, and then it's about 75 is about the actual municipality's obligation that they need to report. Very similar exhibits. Instead of net pension liability, you have net OPEB liability. Instead of pension expense, you have OPEB expense. And then those 10-year histories. The contributions are generally not as relevant in most of the reports we do because most of our OPEB plans we work with are not funded. So there's not, like a pension fund, you have an actual trust that you're paying benefits from. Most OPEB benefits are not paid from a trust. They're what's called pay-as-you-go. Benefits, the annual contribution in equals the benefits out for the year. There's no trust to funnel benefit payments through in most cases. We will touch on that again a little bit. So now that's kind of the super high level breakdown of those three reports and what they're all about. Let's talk about some of the differences between them. First, I want to start off with probably the most important slide in this presentation, which is these 3 points right here. Very, very important. I see mistakes like this happen regularly, and it's concerning. I've had finance directors call me and they say, oh, hey, I already know what we're going to contribute to the fund for the next 20 years because it's in the back of the GASB 6768 report. And I have to go, absolutely not. That is not correct. There is a projection of future cash flows in the GASB 6768 report that is not for funding purposes. It's confusing because it will say employer contribution. And so if you were an employer, you might say, well, this says what the employer contribution should be. So now I know what to budget. If you budgeted on that way, you would have a very severe funding shortfall in the long run because the key part is that middle piece is that GASB reporting assumes a closed group. When I say a closed group, I mean that you just take it's as if the pension fund was frozen. So you would take the plan population today and assume no one will ever receive benefits going forward. Only the people that are in the fund today will continue to accrue service until they retire. But like in reality, as we know in working with most pension funds, when John the retiree leaves, Paul the new hire enters into the fund to replace them generally, right? You usually have a pretty consistent headcount. With GASB reporting, it's going to eventually wind down because as members go to retire and they're not replaced by new employees, as you can imagine, you run out a long-term projection of those cash flows. Eventually, there's going to be nobody left. So at some point, you could look at the GASB report and it's going to say, oh, the employer doesn't need to contribute anything in 60 years from now because there's no more benefit obligations to be had. That's not realistic. That's just what GASB requires us to do. So the Governmental Accounting Standards Board, very specific, even down to the exhibits in that report are prescribed by GASB. They say you need to include this exhibit. It needs to include this. This is the methodology. We follow that. It's not necessarily giving the most realistic picture of the future. It's just what's required for financial statement reporting. I think kind of one way to think about it is it's giving you a sense of
if you took the current pension fund today and just closed it off to new entrants, then this would show you how would that fund perform. Would you be able to pay all your benefits for your current members as is, or is there a cash flow concern? That's the really key takeaway from a GASB report. Don't rely upon GASB reports to project future funding amounts to a pension fund. That is not the correct methodology. Interestingly enough, that third bullet point there, funding reports impact GASB reports. GASB reports do not impact funding reports. We'll get into that in a little bit, and you'll kind of see why exactly that is. Let's talk about funding policy a little bit. So I want to talk funding policy, and then I want to talk assumptions. So when it comes to funding reports, I think it's a little bit more straightforward to think about funding policy. Funding policy is based on a policy that's approved by our clients. So sometimes our clients at Lauterbach and Amon in producing actuarial reports are municipalities. Sometimes it's pension boards. We defer to basically who is our engagement with. That is our client. So we talk to them about, what do you want your funding policy to be? There's a lot of different components of funding policy. We'll drill into that a little bit more later, but I just summarized some of the high-level points when it comes to funding policy, specifically applied to actuarial funding reports that we produce at Lauterbach and Amon for Illinois funds. The key pieces are the actuarial cost method. Really, we only use 2 cost methods here. There's probably at least 10 different actuarial cost methods that could be utilized. But here in Illinois, we use entry age normal. You'll find that under our recommended contribution for pretty much every single fund, minus maybe 1 or 2, we use entry age normal to project, to basically determine that funding policy. Alternatively, there's projected unit credit. I'll show you what some of the differences between those two are. The amortization method, you can use typically, again in Illinois, level percent of payroll or level dollar are the common approaches. There's other methodologies as well, but those are the most common that we see. Amortization target, again, typical, but not necessarily the across the board always, is typically our recommended contribution is based on 100% funding over about 15 years. The reason why that 15 years is in place right now is because currently Illinois statutory minimum funding policy, which is not the recommended policy, is to target 90% funding on a projected unit credit basis by the year 2040. So we're sitting here today, it's 2025 to 2040, 15 years. So that's why you see very commonly that we use a 15-year amortization for paying off unfunded liability in our actuarial funding reports. There's nothing magical about 2040. It's just what happens to be current state statute. That will probably be changing in some point in the very near future. There is Senate Bill 1937 is out there right now that would extend statutory minimum funding target, if it got approved, which it hasn't yet, to 2055. So it would require municipalities to target 90% funding by 2055 instead of 2040. And it would still be on that projected unit credit basis. So interesting. There's definitely going to be some sort of a shift when it comes to statutory minimum funding policy in the near term. When we as consultants at Lauterbach and Amon talk to our clients, whether it be pension boards or municipalities, we highly discourage moving in lockstep with statutory minimum funding policy. It is a long-term significant detriment to the pension fund and the members and the taxpayers of the community, because really what you're doing is you're just dragging out that debt over a longer period of time. Think about you're buying a house and you're getting a mortgage, right? If you had enough money to get a 15-year mortgage as opposed to a 30-year mortgage, and you look at the difference that you'll pay in interest on that term of the mortgage, you save a ton of money to get a 15-year mortgage, right? Same basic concept when it comes to amortization period for paying off unfunded liability. The shorter that time period is, the less interest you're going to be paying over the course of the loan or the funding policy. So it's ultimately if that change does happen at the state level, we're going to have pretty serious conversations with most of our clients to suggest that, stick to your knitting, stay with the funding policy you have in place, continue to pay off your unfunded liability as you have been, or there's other methodologies to pay off unfunded liability, but don't go to the 2055 target. That's a really bad choice. It will make it so that your payment towards unfunded liability would be less than interest for approximately 10 to 15 years, 10 years at the minimum. So let's say 10 years, you're paying less than interest on unfunded liability. That means every year your funded status will go down. So instead of you kind of always want to be going up and targeting that full funding on that statutory minimum basis by 2055, that your funded status will actually go down each year, not up. When we talk GASB 67, 68 reports, we use the term funding policy, but it's in a different context. So funding policy from a funding standpoint is how are we going to fund the pension fund? Funding policy from a GASB 67, 68 standpoint is how are we going to project future contributions? So similar idea, but a little bit different. So you see the kind of fun graphic I picked here. I was like, oh, the suit and tie, you've got your formal funding policy. So this is a best case scenario. For a municipality, they would adopt what's called a formal funding policy. It's basically a written agreement that they approve by the village or city council board action to commit to funding at a certain level. Generally, the commitment is to fund 100% of the recommended contribution for the foreseeable future. Alternatively, and much more commonly, most municipalities do not adopt formal funding policies. They have what's called an informal funding policy. So it's like a t-shirt and some shorts, right? Just kind of hanging out there. We don't have anything formal. The idea is that in lieu of having a formal funding policy, we as the actuaries, we still need some way to project future employer contributions. We need a way, because when we do this projection of cash flows, that's a super important variable in the process is how much is the municipality going to contribute to the fund? We use this informal funding policy in that case, which is the vast majority. I'm going to say 80, 90% of our clients, we probably use an informal funding policy. The way we derive that informal funding policy is we take a 5-year average of how much the employer has contributed divided by what was the recommended amount for that year, trued up for timing. For example, let's say the employer was contributing 90% of that recommended contribution. If they did that 1 year, that's great. If that can vary over the last 5 years, right? They could have some good years in there and some bad years in there. Sometimes maybe they over contributed, sometimes they under contributed. We take the average of those 5 years to then assume going forward, that's what the employer will contribute. So in a perfect world, even if a municipality didn't have a formal funding policy, every year they would contribute exactly 100% of the recommended contribution. And then when we do a forward-looking projection to project future contributions, we would say, oh, in the last 5 years, on average, they contributed 100% of the recommended contribution. So then on a going forward basis, we can assume they'll continue to contribute that. And so that's good. Generally, in 99.9% of cases, if that's the case, and the municipality's funding 100% of the recommended contribution, the recommended contribution from the funding report is enough to target 100% funding. The fund's going to be able to pay out all future benefit payments in full for the current membership because you will get to 100% funded. A lot of the times that's not the case. So here's an example of that not being the case. This is what's called a solvency test. It's an 80-year projection of cash flows. Couple key variables feed in here, a lot of which are determined by us as actuaries, right? Projected benefit payments, like that's kind of our job. We need to project that out. But that key piece that we feed in is that employer contribution. So we're trying to estimate how much will the employer contribute on a going forward basis. And this is a fund that wasn't so good. I'm going to say, I don't want to name names, but it might be a South Chicago suburb. You might be familiar with them. And what you see here is not a great trend. So that black line, it is very normal and typical to see that curvature to the black line. As we assume a closed group, right? You take your current fund membership and then you project what are future cash flows going to look like. Today, you have active members. They're contributing into the pension fund. They're making contributions. So over the next few years, almost every single fund, you should anticipate a growing asset base between employee contributions, municipal contributions, and investment earnings. Those three cash flows should result in a positive projected cash flow. It is for this one. And then you see pretty dramatically right about 16 years from now. So that's probably right around the time when your active members, the vast majority of them are going to transition into retirement. So let's just say the average active member is 35 years old today, right? So then 16 years from now, they're going to be 51. they're going to be in their 50s and they're going to start retiring. They're going to start collecting benefits. So now what's going to happen to your pension fund is you're going to go from a situation where you had a bunch of active members paying in to now you just have a bunch of retirees drawing benefits out of the fund, right? So that's where almost every single projected solvency test is going to have that curvature to it, where you're going to have a growth and then you're going to have a decline once you're basically just only paying out pension benefits to retirees, right? It's going to draw down your assets. That's natural. That's fine. But the problem with this fund that you can kind of see here is the dotted blue line represents benefit payments paid out by the fund over time. The solid black line is the fiduciary net position, aka the ending asset value of the fund for each year. What we don't want to see is those 2 points crossing over. This is referred to, some actuaries call it the crossover point. It's not a good thing. You don't want to have a crossover point. A crossover point means you're going to run out of money, meaning the pension fund will have $0 in assets, but you're still paying out benefit payments to current members. So notice in about year 27, maybe to year 28 or so in this chart, you see the projected ending net position drops to absolutely zero. So that's when we would say, well, your pension fund doesn't have any more money. You're out of money. But guess what? You're still paying out benefit payments at nearly $2 million a year. So this is not so great. We don't love to see this result for our funds. And it's really more than anything, it's a reflective of the fact that this pension fund is not getting their 5-year average 100% of the recommended contribution. It's indicative of the fact that the municipality must be giving this pension fund less than the full funding amount that they're requesting to be 100% funded. So that's what this looks like. The way this materializes in terms of implications to a municipality is that in this time period where, I'm so tempted to walk over there, but I shouldn't. So for the first 26 years, when there is an asset value, a non-zero asset value, right? We can utilize the expected rate of return on investments to project the growth of the fund. So typically most funds expected rate of return is like 6.5% to 7% per year. Then once you have nothing, once your pension fund has $0, right? How can we assume that your investments will return 6.5%? 6.5% of what? There's no investment. You don't have any money left, right? So the way this materializes in the calculation is up through that year of insolvency. Let's just call it 26 years for this fund for simplicity. Over the next 26 years, we use that, say, 6.5% expected rate of return to discount future cash flows, calculate present values. Subsequent to that date, you can't say that you could earn 6.5% because there's no asset base to grow. We rely upon a 20-year general obligation municipal bond rate. These days, those are running in the high 4s, low 5% range. So then when we then calculate what's called the single effective discount rate for GASB reporting, we say, okay, if you're discounting the next 26 years of cash flows at 6.5%, and then everything after that, the next 54 years of cash flows in this 80-year projection at, say, 4.5 or 5%, you're going to use some sort of a discount rate that's less than 6.5. It's going to be a blend of the two. The lower discount rate you use to value liability, the higher the liability. So in a situation like this, for this community, for example, when they go to do their audit and they report their balance sheet liability, their total pension liability for their pension fund, it is significantly higher because of this projected insolvency than it would be if they were projected to be fully solvent. So if these lines never crossed over, we'd say 6.5%. That's your single effective discount rate. Be done with it. But instead, maybe for this one, we're using 5.5%. And I'll tell you that the difference between over 80 years, 1% difference in an interest rate is a very, very, very substantial difference. We're talking millions of dollars of balance sheet liability for municipalities to report in their audit. So it is really important. And what I'm trying to get at here too is that funding reports tell part of the history, part of the picture of the funding of the pension fund and kind of where you're at. But the GASB reports tell another side of the story too. So it's important to view these reports together. Together, they really tell the full picture of the health of a pension fund, which we'll dig into a little bit more. Oh, I kind of jumped the gun on this one. So this is what I just said. Before assets run out, we utilize expected rate of return. Afterwards, general obligation bond rate, total pension liability is discounted at that single effective discount rate. It's the blend of the two. When it comes to GASB 7475 reporting, a little bit different. Again, I'm operating under the assumption that
the vast majority of municipalities we work with in Illinois do not have an OPEB trust. They don't have a dedicated, kind of like a pension fund, to pay out other post-employment benefits. They're usually operating as a pay-as-you-go. So if there's no OPEB trust, which is, say, 99% of Illinois municipalities, then that discount rate is just equal to the 20-year general obligation bond rate. So it's that 4.5%, maybe 5% rate. Actually, to side point, little teaser for why it is really awesome to have an OPEB trust, and I wish we saw more of it in Illinois, is that by establishing an OPEB trust, number one, now when you report your net OPEB liability, every dollar you have in that OPEB trust offsets your total OPEB liability dollar for dollar, right? So you have $5 in there, you have $5 less in net OPEB liability. Additionally, we do a solvency test if there is an OPEB trust, very similar to GASB 6768, which can then make it so that instead of having to use just 100% of that bond rate, 4.5%, for example, you might be able to use some sort of a blend of 4.5 and 6.5. So then you could use, say, a 6% rate to discount those liabilities. And that could significantly reduce your liability by using a higher discount rate. So there's a lot of benefit to establishing OPEB trusts. It's just not really commonplace in Illinois. In other states that we work with, we do a lot of OPEB valuations in Wisconsin, very prevalent. Almost all Wisconsin municipalities have an OPEB trust dedicated to pay OPEB benefits. So pretty good advantages there. Assumptions. So we talked funding policy, shifting gears a little bit to assumptions. There's a pretty exhaustive list on your screen of pretty much all of the actuarial assumptions that we utilize to produce a valuation. These are actually all pretty much common. So we talked about what's different funding and GASB, what's the same. For the most part, these assumptions are pretty much the same between a funding and a GASB report. You're not going to see much deviation. The biggest piece would be that first one, which is discount rate, where on the funding side, your expected rate of return on investments equals your discount rate. So you value liabilities at the same rate that you value asset growth on a funding report. For a GASB 6768 report, it's what we just talked about, that solvency test, where you could use some sort of a blend of an expected rate of return and a bond rate. So there's a little bit of difference there. Other than that, everything is pretty consistent amongst the two reports. So projected individual pay increases differs from total payroll increases. Total payroll is how much you expect the total pay paid out of the pension fund to increase by per year. That assumption is generally a little bit lower than what the individual pay increase is, because individual pay is looking at individual members. So like Joe the firefighter, right? What's his expected increase in his benefit, or sorry, in his salary next year? That would be your individual pay increase. For the fund population, it's usually a little bit less, because think about that situation where Joe retires and Steve replaces him, right? Then you go from paying out somebody, probably higher comp, let's say they're retire and they're making $100,000, and you hire a new employee and they're making $60,000, right? So now the total paying for the population actually went down due to that demographic event. But for an individual, we generally expect higher expected rates of pay increase per year. Inflation is a key assumption. The same as basically CPIU. That's what we utilize for inflation in Illinois. Retirement rates, we use, this is actually a new thing, as well, our latest assumption study we implemented this year. We do utilize different retirement rates for tier 1 and tier 2 members. We're trying to capture the idea that tier 2 members can retire earlier with a reduction in their benefit, which is going to result in less early retirements, right? People don't like to take a reduction in their benefit. If you retire as early as age 50 under tier 2, you'd be taking a 30% cut in your benefit. You wait until 55, you get the full benefit. So we've basically established our retirement rates to account for that and project what we expect to see in terms of retirement trends. Not a ton of tier 2 retirees out there to utilize actual data. So this is more projected for the future. Because just for reference, tier 2, anyone hired after January 1, 2011. So we're kind of just getting to the point now where there's a couple tier 2 retirees entering into retirement. Prior to this time, no one really had achieved the retirement eligibility conditions because it only went into effect 2011. Termination rates, disability rates, mortality improvement rates, and marital assumptions. These are all key assumptions that we utilize to project future benefits. As you can imagine, all these different things impact how much benefits the fund's paying, and then that really impacts the liability associated with the pension fund. Wanted to go over a couple high-level key differences between funding and GASB. So on the funding side,
we work together with the client, but ultimately the client owns, whether that's the pension fund or the municipality, they own that discount rate, that expected rate of return on investments. We defer to them on what this assumption should be, right? If they say, hey, we want to use 7%, say, oh, that's reasonable, we can do it. They say, hey, we want to use 4%, we can say, hey, that's not reasonable, but we can do it. I mean, we're just going to disclose in your report that we don't think it's reasonable. So there are a couple funds out there that utilize kind of outside of the reasonable range assumptions. We just disclose those in our reports that we're not necessarily supporting that. We were just directed to utilize that. GASB, we talked about this at length. The GASB dictates the process for determining the discount rate. It's not determined by the client. Funding reports are based on the current members in the fund today. It's a snapshot date. So if your fiscal year end is, say, April 30, 2025, you just take every single member in the fund at April 30, 2025, and then you do all your valuation based on that census data. When it comes to the GASB reporting, we're taking that same fund population, but then we're projecting forward for the future. So the funding is not really a forward-looking projection. It's more of a today measurement. The GASB reporting is more of a forward-looking type of a projection. On the funding side, we utilize the actuarial value of assets, love that term, to value the unfunded liability within the fund, versus on the GASB side, we use fair value of assets. The difference between the two, when I say actuarial value of assets, we take the difference between expected and actual investment return each year, and we smooth it out over a 5-year period. It's actually really simple math. You basically just said, hey, if the fund returned 3 million, but we thought it would get 2 million, then that's a $1 million asset gain. And then we take that gain and then we recognize 20% of it each year. So, $200,000, 200,000, 200, until we've fully recognized that over a 5-year period. Funding reports are always based on at least the ones produced by Lauterbach and Naiman are always based on current year's census data. So when we say it's the fiscal year end April 30, 2025 actuarial valuation report, it's based on the census data as of that date. When it comes to GASB reporting, particularly GASB 6768 reporting, we use the term on a lag. This is kind of more of an internal term. It's not an official industry term. But what that means when I say GASB on a lag, it means that we're utilizing the prior year census data to do this year's GASB reporting. So again, you're trying to do a fiscal year end 4/30/2025 GASB 6768 report. Most of them, about 80% of our reports, would utilize the fiscal year end 4/30/2024 data. That can get a little confusing. We'll talk about timing conventions. That definitely trips people up a lot sometimes. I'll send a report and they come back and they're like, no, there was 40 people active in our pension fund at April 30, 25. And I'm like, yeah, I know, but it's because we're utilizing last year's census data. So that is kind of a little bit of a nuanced thing when it comes to the GASB reporting. GASB 7475 reporting is done every other year. It's not done, the reporting is done every year. The census data collection is done every other year. So one year, the GASB 7475 reporting is done on current data. The next year, it's done on the prior data. The year after that, current data. The year after that, prior data. So it keeps cycling, alternating. Talk about timing components. So getting into kind of what I just mentioned a little bit. So we have your fiscal year end. So that, I think most people are pretty familiar with that term. That's the end of the 12-month financial period for the employer or for the plan. I've seen like maybe 2 or 3 cases where pension funds will have a different fiscal year end than a municipality. It's super duper rare. Tri-state FPD jumps to mind, that they use a different date. Other than that, for the most part, pretty much all pension funds utilize the same fiscal year end as their municipality. You'll see a disclosure in our report, more of an L&A term. It's called data date. What we're getting at here is it's the snapshot date of what that underlying census data is based on. So for example, if it was a GASB on lag report for fiscal year end 4/30/2025, you might see it'll say data date 4/30/2024. That's indicating that it's the 1-year look back on the census data. The valuation date is the date at which liability is calculated. This is another one that can trip people up because I'll send along a GASB report and I'll say, hey, here's your GASB report for fiscal year end 4/30/2025. And then I get an email back and they go, I think you sent the wrong report, Kevin, because it says on the front, it says May 1, 2024. And I'm like, yeah, I know. It's confusing. It's because that's when we are valuing the liability as of, right? So we collect census data at 4/30/24. The valuation date for actuarial purposes is just the day after. the census data. So May 1, 2024. The measurement date, the next one here, that's when the information is reported as of. So in that GASB report for fiscal 4/30/25, we'll take the May 1, 24 valuation date, and then we roll those results forward with a full year to report it as of the measurement date, as of April 30, 25. We, for the most part, in reports that are produced by Lauterbach and Amon, measurement date and fiscal year end are generally the same. That being said, it's not necessarily has to be the case. I've seen other actuaries use different conventions where for one fiscal year end, they'll use the prior year as the measurement date. So I believe, don't quote me on that. There's rules about how far the measurement date can deviate from fiscal year end. I know that 1 year is definitely within the timeline. I'm not sure what the upper limit on that is. So sometimes we see that done, but not our reports. And then the contribution year end, so there's another one that can kind of yield a little bit of confusion, is if you look in a funding report, right on the front, it's going to say, so I'm going to call it, generally like most of our consultants at Lauterbach and Amon are going to say, hey, here's your fiscal year end 4/30/2025 actuarial funding report. And then on the front cover of the report, it's going to say, for the fiscal year end April 30, 2026. And people are like, well, but isn't it what I don't, so it's because here's the idea is that when we take census data at April 30, 25, we do a value that just starts the process, right? So it takes a while. Like we need to collect that data from the client. We need to reconcile that data. We need to complete our valuation. We need to draft a report. This goes through multiple layers of review at each step in that process throughout our firm as it moves through our different departments and teams. Eventually it gets to the point where we have the final report. We give that funding recommendation to a pension board. They then submit that request to their municipality. But at that point, so many months have gone by, right? It's not gonna, by the time we calculate that contribution amount, they can't have deposited it on 4/30/25 if we didn't even give it to them until July of 2025, right? So the way we calculate a recommended contribution in the reports is we always include 1 year of interest from the fiscal year end of the data collection to the date we expect the contribution to be received. To be honest, in a lot of municipalities, it's actually more, it probably takes longer than that. It takes longer than a year. Commonly, it takes 2 years for between the fiscal year end and when the money's actually deposited into the fund. So quick walkthrough of a timeline of what that might look like. So April 30, 25. Awesome. I send a request to the client. We need your data. Can you send along the data? Let's say I get the data, if it's a really great client, end of May. They give us that data end of May. We start working on their valuation. Takes us about a month to produce that report. We finish up the report end of June. So we're in June 2025 now. We attend a pension board meeting in July of 2025. We tell them, here's your recommended contribution. They say, that looks great. Oh, but the audit's not done. Oh, we're going to have to wait until your next quarterly board meeting to approve that. So then in Q4, so now we're in like October of 2025. Pension board's got final audited financials, final funding report. They say, great, we're going to send this along to our municipality, ask them to contribute this dollar amount to the pension fund. Okay. Municipality receives that funding request. They usually accompanied by a municipal compliance report. And then the idea is that most municipalities fund their pension fund via tax levy. They'll approve their tax levy in November or December of that calendar year. I think the third week in December is the absolute latest deadline. And then those revenues will be collected via property taxes over the subsequent calendar year. So now we're December 2025. They took that 4/30/25 funding recommendation. They levied a tax. Let's hope that the municipality said, yeah, we agree. We'll put in the $3 million you asked for, right, into our property tax levy. Then it's collected in property tax installments over the following calendar year. Since most of our clients operate on a 4/30 fiscal year end, I'll explain it in that context. It's a little bit more complicated that way. But then so December happens, right? They go, we'll collect that during next calendar year. Generally, property taxes are collected in 2 installments, one towards the beginning half of the year, one towards the later half of the year. It varies between different counties and the way that timing works out. Most of the time, the majority of the revenue associated with that tax levy that happened in December 2025 is going to happen in the later half of 2026. It's going to happen sometime after April 30 of 2026. So now that April 30, 2026 happened, well, guess what? That was April 30, 2026 fiscal year end just ended. You haven't even gotten the dollars from the 4/30/25 actuarial report. So when that money comes into the fund, let's say it's May, June, July, August, September, November, December of 2026, guess what fiscal year end that's in? Fiscal year end 4/30/2027, because it's between May 1, 26 to April 30, 27. So definitely confusing, but typically that's the way when we're going the GASB report and we say, what's your contribution as a percentage of the actuarially determined contribution? We're usually saying what was deposited in the pension fund during, for example, fiscal year end 4/30/2027. We go back and we open up the fiscal 4/30/2025 funding report and we compare those two numbers to say, did you contribute 100% of that amount? That's typically the convention we use. Varies from municipality to municipality. Some use a 1-year look back, some use a 3-year look back, but most commonly it's a 2-year look back on that actuarially determined contribution. Why are these reports important? And this is kind of just some wrap up comments here, and then we'll finish this up. I think so. If I was on a pension board prior to consolidation, I think that one of the absolute most important responsibilities of a pension fund was definitely making informed investment decisions. They worked with a local investment advisor who could invest the assets of that pension fund basically according to the direction of the board. That was a really important responsibility. That responsibility has been siphoned away from local boards, and it happens at the state level now from IFPIF and IPOPIF. So that responsibility is no longer relevant to local boards. To me, boards have a lot of responsibilities. A lot of what they're doing on a day-to-day basis is approving things that kind of just have to be approved. Oh, this member got benefits. Yeah, okay, you got benefits. Oh, new member in the fund. Yep, they're in the fund. There's not really anything you can do about that. You're kind of going through the motions to document things. To me, there's two absolutely critical functions of local pension boards today that remain. Number one, adjudicating disability hearings, right? Determining whether or not a member will receive disability benefits and whether they're duty or non-duty, absolutely critical function. And to me, the second most important, and I think it's very relevant to what we do, is making a sound funding recommendation to their municipality, right? The members of that pension board, they're fiduciaries to the pension fund. They have a responsibility to provide benefits to the best of their ability to those members and make sure their fund is going to be able to pay out future benefits. What could be more important than asking that municipality to fund at a reasonable level on a going forward basis, right? So that's why a funding report, absolutely critical. After consolidation happened, we had a lot of clients coming to us and they said, oh, consolidate, like we don't need a funding report anymore. And I'm like, what are you talking about? If it's more important than ever before, now you don't have control of your investment authority. If you don't hire an actuary like Lauterbach and Amon or another private actuary, right? It doesn't have to be us. Then the only number your municipality is going to see is the statutory minimum contribution that IFPIF and IPOPIF are going to calculate. That's going to be 90% funded by 2040. And as I alluded to earlier, maybe 90% by 2055. That's not a good way to fund a pension fund. You can even ask the actuaries that produce those reports, and they will tell you, this is horrible funding. Don't do it. And so it's more important than ever in today's environment to have that sound funding recommendation, something better than a statutory minimum funding request, like what we produce, which is a recommended contribution. And the typical differences are you're targeting 100% funding instead of 90, and you're usually targeting it, faster than that 2040 date, or maybe in line with that, or using different funding policies. We also use entry age normal to value liability, much more stable cost method as compared to projected unit credit, backloads pension costs to the later half of members' working careers. Never a good plan. So to me, funding reports, absolutely critical. And then I think the other piece that comes from an actuarial funding report, reviewing it, just making sure your assumptions are right, making sure your funding policy makes sense for your unique position. Some funds we work with, it's like a 1-member fund. I wouldn't talk to a 1-member fund the same way I would talk to Elgin Fire and Police, right? They have different objectives, different time horizon, different risk, profiles. And so it's important, these are done really customized to the fund when we produce them. The reports from IFPIF, IPOPIF, it's one size fits all. Every single one is exactly the same calculation. There's no attention paid to like the unique situation of an individualized pension fund. When it comes to 67, 68, 74, 75 reports, literally they're required as part of the municipality's audit, so that's pretty important. If you don't do them, then you're going to have a little nasty gram in your audit right on the management summary. And it's going to say, hey, you were supposed to implement GASB 6768 or 7475 and you didn't. So it's like a ding against you. You don't want to have that. And then on top of that, I think it's a really useful resource to review those 10-year histories. Like I said, using the two reports together, right? Funding report tells you kind of some information. The GASB report gives you a little bit more of that forward-looking projection, history of what's been contributed to the fund. So together, I think they're a really useful resource. So I just want to say thank you to everybody for attending today's training. Kind of giving this a shot. Remember, the key takeaways here: GASB reports do not inform how to fund for the future. Don't look at projected contributions in a GASB report to project future employer contributions. And then my key point that I also wanted to make too is together, if we look at a funding report and a GASB report, you have a really good sense of the overall health of the fund. So thanks everyone for attending today. Have a great day.